I am your host Zayed Haji, and before we begin, a brief disclaimer. The Islamic Finance Research Podcast draws upon credible public sources, including the Indian Government Budget Report, Indian Economic Survey reports, RBI publications, company annual reports from NSE and BSE, and analytical platforms such as Screener.in and Tickerphonology. All content here is shared strictly for educational purposes within the context of Islamic finance and company research. We do not provide stock tips, investment advice, or buy or sell recommendations. This material should never be treated as a substitute for professional financial guidance, nor as the sole basis for making investment decisions. The Islamic Finance Research Podcast is not registered with SEBI and is produced independently by students and researchers dedicated to the study of finance. Most people quit in the first minute, but those who stay until the last word, they walk away with an edge the crowd will never have. Now let's begin. When we speak of legacy brands that shaped India's industrial story, Bombay Dyeing and Manufacturing Company Limited stands tall. Listed on both the NSE and BSE and anchored in the textile sector, its name carries echoes of history, transformation, and resilience. Yet this is not a company frozen in the past, it is a living example of how industries evolve with time. Once synonymous with premium fabrics that dressed households across the nation, Bombay Dyeing has expanded its horizon beyond textiles. Today it engages in three powerful verticals: real estate development, polyester staple fiber, and retail textiles. Each of these segments is not just a business unit, it is a chapter in the company's ongoing story of reinvention. The real estate arm reflects its vision of shaping skylines, building not just structures but communities. Polyester staple fiber, meanwhile, connects the company to the beating heart of modern industry, feeding demand in sectors ranging from fashion to furnishings. And of course, retail textiles remain the familiar face of Bombay Dyeing, a brand deeply woven into the fabric of Indian households for generations. Your attention span is your greatest weakness, but if you can hold it even for these few minutes, the insights you gain will last far longer than the time you spend here. In the evolving landscape of Indian industry, Bombay Dyeing and Manufacturing Company stands as a symbol of reinvention and resilience, commanding its presence across real estate development, polyester staple fiber, and retail textiles. Its story is not just about business, it is about shaping markets, influencing lifestyles, and defining progress. The company's largest strength lies in polyester, contributing 88% in the first half of financial year 2025 compared with 77% in financial year 2022. Here, cutting-edge technology from Invista Polyester Technologies and Chemtex International Incorporated, a United States of America, powers the production of 100% virgin polyester staple fiber and textile-grade PET chips. Its range spans from 0.6 to 7 deniers, offering specialized innovations such as micro, optical white, dope-dyed black, and trilobal. With a 12% market share, it is one of only 7 producers of polyester staple fiber in India, cementing its place as a key player in the nation's industrial fabric. The company also leaves its mark in real estate, which contributed 9% in the first half of financial year 2025 compared with 22% in financial year 2022. Its portfolio includes landmark developments such as Springs and the Axis Bank headquarters in Mumbai. The crown jewel remains the island city centre towers 1 and 2 at Dadhar East, Mumbai, where the entire inventory of residences has been sold. With occupancy certificates already secured for most units and the full occupancy certificate expected imminently, the project reflects BOMDYEING's precision and vision. Looking ahead, the company announced in September 2023 the development of Phase 3 of Island City Centre, adding approximately 1.2 million square feet out of a total 3.5 million square feet. Further joint development opportunities are also under active exploration. Its retail segment, though contributing a modest 3% in the first half of financial year 2025, compared with 1% in financial year 2022, anchors the brand deeply into everyday life. With over 350 exclusive stores and a presence in more than 2,000 multi-brand outlets across India, the company delivers a wide spectrum of products, linens, towels, furnishings, leisure wear, and children's clothing that keep the Bombay dyeing heritage alive in homes across the nation. The company's reach spans beyond borders, with 72% of revenues generated in India during financial year 2024 compared with 66% in financial year 2022 and 28% from exports compared with 34% in the same period. Today, its products travel to over 20 countries across Europe, North and South America, the Middle East, Africa and Asia, carrying Indian innovation to the world. At the foundation of this success is its manufacturing strength. The polyester staple fiber facility at Patal Ganga, Raigad, Maharashtra, operated at 86% capacity utilization in financial year 2024 compared with 93% in financial year 2022, demonstrating its scale and efficiency. Bombay dyeing is not merely surviving in shifting markets, it is strategically transforming. With innovation in polyester, vision in real estate, and presence in retail, the company is building more than products and projects. It is shaping the future of Indian industry with ambition, foresight, and relentless momentum. In the corridors of Indian corporate history, few stories illustrate resilience and reinvention as powerfully as that of Bombay Dyeing and Manufacturing Company. The company's journey in recent years has not been defined by hesitation, but by bold decisions that dismantle the weight of the past and lay the foundation for a future of clarity and strength. In October 2023, Bombay Dyeing took a decisive step by finalizing the sale of Phase 1 of its 22-acre land parcel in Worli, Mumbai, to BSE Realty Private Limited, a subsidiary of Sumitomo Realty and Development Company Limited, for a landmark consideration of 4,685 rupees crore. This single act transformed its balance sheet, allowing the company to clear all debt obligations in financial year 2024 and emerge debt-free. The transformation continued in August 2024 when Phase 2 of the sale was completed, yielding an additional 534 rupees crore. In just under a year, Bombay Dyeing turned the burden of debt into a narrative of financial liberation. Strengthened by this clarity, the company fortified its foundation further through strategic investments. By financial year 2024, it held 675 rupees crore in equity and debt instruments, nearly doubling its position from 367 rupees crore in financial year 2022. These numbers are not mere statistics, they reflect foresight, a commitment to stability and a vision for sustainable growth. Yet no story of resilience is complete without challenges. In October 2022, the Securities and Exchange Board of India (SEBI) issued an order barring the company and its promoter entities, Nestle Wadia, Nes Wadia and Jahangir Wadia from the securities market for 2 years, citing alleged misrepresentation of financial statements spanning financial year 2012 to financial year 2017. The order carried penalties of 2.25 rupees crore on the company and 11 rupees crore on the Wadias. But here too the company acted decisively, appealing the order before the Securities Appellate Tribunal (SAT), which granted a stay in November 2022, keeping the path of continuity intact. Amid this backdrop of transformation, Bombay Dyeing's shareholding pattern as of June 2025 speaks volumes about its ownership structure and the confidence it commands. Promoters hold 53.58%, foreign institutional investors 0.96%, domestic institutional investors 1.13%, while the public accounts for 44.33%, represented by a strong base of 151,349 shareholders. This diverse ownership reflects not only trust but also the collective belief of stakeholders in the company's trajectory. Bombay Dyeing's recent journey is not merely about transactions, investments, or legal challenges. It is about strategic transformation, a company that has cleared its past burdens, fortified its present, and positioned itself to seize the future with courage and precision. I challenge you, stay till the end. If these next few minutes do not reshape how you think about business, you owe me nothing. The story of Bombay Dyeing and Manufacturing Company is not just a corporate timeline, it is a narrative of bold reinvention, where every decision, every restructuring, and every expansion carried the weight of strategy and the clarity of vision. In 1997, the company embraced modernization by joining the National Securities Depository Limited, enabling electronic trading and dematerialization of shares, a decisive leap into efficiency and transparency. By 1999, with rising costs eroding profitability, the board chose to sell or lease the underperforming Roha processing plant, signaling the first act of strategic restructuring. The early 2000s were marked by decisive transformation. In 2002, a court-approved financial restructuring erased legacy costs, strengthened shareholder value, and redirected textile exports towards high-value made-up products, particularly for the United States market, backed by a full order book. The company launched its first share buyback, reducing equity capital. The following year, 2003, saw even bolder moves. A joint venture with Proline India Limited for ready-made garments, divestment of majority stakes in subsidiaries, a second share buyback, and the start of restructuring its textile base to pivot from in-house production toward brand-led growth. That same year, tax demands arose, now under appeal. By 2004, operations consolidated at Worli, and development began on the Spring Mill land after regulatory approvals. Old equipment was disposed of, and approximately 1,100 positions were reduced through voluntary separation, while further equity rationalization continued through buybacks. Shares were voluntarily delisted from Delhi and Madras stock exchanges as part of capital market streamlining. The year 2005 marked a forward leap. A 165,000 tons per annum polyester staple fiber plant was initiated at the DMT site, anchoring entry into downstream integration. A processing and stitching unit was launched in Maharashtra to leverage the new quota-free export regime. Real estate monetization began with Spring Mills and Worli developments, though a public interest litigation temporarily delayed progress. Another 450 positions were reduced through voluntary separation as restructuring deepened. In 2006, the Supreme Court cleared the path for construction at Spring Mills and Worli, unlocking large-scale residential, commercial, and retail development. A greenfield textile processing unit at Ranjangaon was launched with a capital expenditure of Rs 189 crore, while a 400 rupees crore polyester staple fiber project neared trial production. EMT operations were suspended to integrate the new downstream plant. Momentum accelerated in 2007 with the polyester staple fiber plant entering trial runs and the Ranjangaon textile unit nearing completion. The Dada residential tower witnessed strong demand, while shopping and commercial developments took shape at both Dada and Worli. A joint venture with Lawson and Tubro for Mumbai redevelopment projects marked a pivotal urban strategy. Simultaneously, workforce restructuring continued with 1,921 voluntary separations at the Worli textile facility. By 2008, the polyester staple fiber division was fully commercialized with utilization exceeding 80%, replacing the legacy DMT business. Ranjangaon entered partial commercial production, and the Spring Mills residential tower was already 40% complete, with over 80% of units pre-sold. Commercial and IT buildings were launched at both Dadar and Worli, while the joint venture with Larsen and Toubro initiated its first redevelopment project. In 2009, full-scale polyester staple fiber operations began, though profitability was tested by excess capacity and price undercutting. The company pivoted to niche fibers to defend margins. The Ranjangaon plant fully transitioned into commercial operations, while real estate advanced. The Spring Mills residential tower neared completion, and the Worli commercial tower reached 30% progress. A commercial building under construction at Worli was sold to a wholly owned special purpose vehicle for 235 rupees crore to enable monetization. The year 2010 saw continued monetization as remaining Worli commercial space and additional Spring Mills flats was sold, while lease income from surplus property created recurring revenue. The polyester staple fiber business achieved utilization of 88%, switched to natural gas and strengthened competitiveness. Construction of Spring Mills residential and Worli commercial towers neared completion, setting the stage for the next wave of real estate growth. In 2011, transformation crystallized. The Worli commercial building was completed and handed over to Axis Bank, while Island City Centre residential towers at Spring Mills were launched and initial units sold. The polyester staple fiber division reached 95% utilization and shifted toward higher margin specialty fibers to capitalize on high cotton prices. The real estate arm rebranded as Bombay Realty, unveiling ambitious mixed-use developments at Island City Centre, Dadar and Worli Island City Centre, projects designed to redefine Mumbai's skyline and BOMDYEING's identity. Think of this as a puzzle. You only see fragments at the start. Stay till the end and you will hold the complete picture no one else dares to show. The journey of BOMDYEING and manufacturing company over the past decade is not a mere sequence of events. It is a chronicle of resilience, reinvention, and relentless pursuit of transformation. In 2012, the company formally relaunched Bombay Realty, unveiling 2 luxury towers, 1 ICC and 2 ICC at Island City Centre, Dadar, while construction began on the Plaza, a luxury retail project at Worli. Apartments in earlier phases were handed over, the next wave of development was set in motion, and promoters infused equity by exercising 7.6 lakh preferential warrants. Group-wide synergies were unlocked through the Wadia brand equity and shared services agreement, even as legal challenges moved from the Bombay High Court to the Supreme Court. By 2014, land handover disputes were resolved by the High Court, unlocking construction at 1 ICC and 2 ICC. The polyester staple fiber division reduced energy costs with a new coal-fired boiler, while textile exports surged 45% year-on-year with new CVC products. Real estate revenues rose to 803 rupees crore, despite a sluggish market, buoyed by regulatory approvals and sector reforms. In 2015, construction of ICC towers officially commenced, and the Plaza project at Worli regained momentum. The Ranjangaon textile processing unit was approved for sale at Rs. 230 crore, targeting debt reduction. The Home and You retail transformation revitalized 300 plus stores, expanded categories with lifestyle and licensed brands like Disney, and global consultants such as Larsen and Toubro, Hill International and Gardner and Theobald were brought in to drive real estate execution. The following year, 2016, ICC Towers construction gathered pace under Larsen and Toubro as general contractor, while Worli project activity resumed after disputes were resolved. Home and You pivoted into multi-channel retail, though the planned Ranjangaon sale collapsed due to buyer default. The polyester staple fiber business focused on cost and product mix strategies to counter import pressures. Transformation deepened in 2017 with the merger of Archway Investment Company Limited via NCLT approval, accelerating construction of ICC towers and initiating the slum redevelopment project. The Ranjangaon asset sale was signed for 205 rupees crore, and Home and You expanded through an e-commerce platform and a franchise-led model. By 2018, ICC Towers neared completion. The slum project was delivery ready, and the Development Control Regulations 2034 unlocked new potential for real estate. Home and You strengthened digital printing, e-commerce, and franchising, while the polyester division continued to defend margins through efficiency and product diversification. The year 2019 marked a milestone. Part occupancy certificates were secured for ICC Towers, handovers began, and cash flows surged as ready inventory attracted demand due to nil goods and services tax. The company prepared to monetize ICC and Worley assets, supported by DCR 2034 reforms. Home and You turned profitable after 4 years, launched 100 new franchise stores, and entered the institutional business. Corporate restructuring advanced with NCLT approval for demerger with Scal Services Limited, alongside reclassification of capital structure and issue of preference shares. By 2021, construction of ICC Towers was nearly complete with partial occupancy received. The polyester staple fiber division restarted post-COVID with utilization above industry average, focusing on specialty products. Retail pivoted to e-commerce to align with consumer shifts, while real estate gained strength from ready-to-move inventory positioned in high-demand Mumbai micro markets, supported by upcoming infrastructure such as the Worli-Surrey link and the new Mumbai airport. In 2022, ICC construction was completed with full occupancy secured for one tower and near completion for the second. Polyester operations scaled to 93% utilization, outperforming industry benchmarks with specialty fibers and diversified products. Real estate capitalized on premium land banks in Mumbai, strengthened further by infrastructure connectivity. Momentum carried into 2023, with ICC Towers completed and occupancy certificates in progress, while the polyester division maintained high utilization at 92%, driven by specialty products and exports. Home and You doubled revenues, reflecting revived consumer demand. A turning point came in 2024 when the company sold its prime Worli land parcel, fully clearing debt obligations and becoming debt-free. Real estate inventory at Island City Centre was completely liquidated with occupancy certificates secured, and surplus capital was redeployed into liquid and marketable instruments, reinforcing financial strength. By 2025, Bombay Dyeing stood debt-free, fortified by liquidity, with its Worli land parcel monetized and Island City Centre inventory fully sold and occupied. The company had redefined itself not as a legacy textile brand, but as a debt-free, strategically transformed enterprise with strong cash flows, premium real estate assets, and a sharpened focus on future growth. If you leave halfway, you will only hear the noise. Stay till the end, and you will hear the truth that changes how you see this company forever. The rise, collapse, and rebirth of Bombay Dyeing and Manufacturing Company, a story told by numbers. The financial history of Bombay Dyeing and Manufacturing Company reads less like a straight path and more like a dramatic saga of survival, collapse, and fragile recovery. Every year etched into its books tells a story of struggle, reinvention, and the heavy weight of choices made. From the years 2015 to 2017, the company appeared trapped in stagnation. Sales hovered between rupees 1,800 crore and rupees 2,300 crore, but the real picture was far darker. Losses deepened, profits turned negative, and net profit margins shrank as low as -7%. Borrowings piled, and the crushing weight of interest eroded any hope of stability. Then came the years 2018 and 2019, a brief but powerful surge. Sales doubled, touching rupees 4,430 crore in 2019, with an astonishing operating margin of 39%. Net profit leaped to rupees 1,228 crore, fueled not by operational excellence, but by real estate monetization. It looked like redemption, but it was not built on the company's core textile strength. It was a windfall born from asset unlocking. The COVID storm of 2020 to 2022 brought the company to its knees once again. Sales collapsed to barely rupees 1,193 crore in 2021. Losses worsened, net margins plummeted to negative 39% and borrowings swelled to a suffocating rupees 4,400 crore. The operating engine nearly died, leaving behind a trail of broken balance sheets and fragile hope. In 2023, a new chapter began. A turning point arrived not from roaring sales but from a balance sheet cleanup. Borrowings were slashed, liabilities trimmed, and the groundwork for survival was laid. Yet truth remained harsh. Sales recovery was modest at rupees 2,674 crore, but losses continued, with a net margin still at negative 19%. The year 2024 became the most deceptive year in the company's history. On the surface, it shone with brilliance. Net profit soared to an unbelievable rupees 2,949 crore. Reserves flipped from negative to positive, and return on capital employed shot to 214%. But beneath the surface, this was not the fruit of operations. Operating profit was negative. The entire turnaround was powered by other income worth rupees 4,057 crore, not by business fundamentals. The core remained broken. By the year 2025, the story reached a fragile equilibrium. Sales stabilized around rupees 1,600 crore. Operating margins were still negative, revealing the weakness in the company's actual operations. And yet, reserves stood strong at rupees 2,330 crore. Borrowings shrank to almost negligible levels at rupees 3 crore, and investments built a foundation of financial safety. The company survived not as a thriving textile powerhouse, but as an entity reshaped by asset monetization and strategic financial maneuvers. The truth is unshakable. The company's profits today do not rise from its core business but from unlocking assets and investments. Its most extraordinary achievement is its debt-free transformation. Borrowings reduced from rupees 4,442 crore in 2022 to just rupees 3 crore in 2024. Reserves turned from negative rupees 1,287 crore in 2023 to positive rupees 2,330 crore in 2025, a swing of nearly rupees 3,600 crore in 2 years. Yet the weakness of operational margins still betrays the fragility of the core business. Dividends remain absent. Management hoards cash not to reward shareholders but to prepare for future asset plays. This is the real strategic truth. Bombay Dyeing and Manufacturing Company cannot yet be viewed as a consistent operating business. Its destiny lies not in textile operations but in how effectively its management continues to unlock, monetize, and redeploy assets. It is not a story of operational revival, it is a story of survival through transformation. There are companies that grow steadily, brick by brick, expanding their foundations with each passing year. And then there are companies like Bombay Dyeing and Manufacturing Company Limited, whose story is not of compounding growth but of dramatic swings between collapse and resurgence, a story of survival powered not by its core business but by the hidden weight of its assets. The truth is stark. Over the years, sales have consistently declined, revenues have weakened, and operating margins have turned negative. What once was a manufacturing powerhouse now finds itself overdependent on non-operating income to sustain a sense of profitability. Yet beneath these cracks lies a different kind of strength, an untapped arsenal of assets, prime land banks in Mumbai, and a brand that still commands recognition. Strengths lie in a debt-free balance sheet built through extraordinary efforts. Borrowings that once stood at rupees 4,442 crore in financial year 2022 were brought down to just rupees 3 crore by financial year 2024. Reserves too have flipped dramatically, from a dangerous negative rupees 1,287 crore in financial year 2023 to a strong positive rupees 2,330 crore by financial year 2025. A transformation of this scale signals resilience but also exposes the nature of this company's lifeline. Because the profits that look spectacular at first glance such as the rupees 2,949 crore net profit in financial year 2024, were not born from operational excellence, but from a windfall of other income amounting to rupees 4,057 crore. These are one-off events, land sales, project monetizations, or investment exits. They are powerful, but they are not sustainable. They are lightning strikes, not steady streams. Opportunities do exist. Mumbai's redevelopment projects and the monetization of prime land banks can unlock enormous value. Strategic alliances and joint ventures in real estate can reshape the company's trajectory. But with every opportunity comes the shadow of threats, real estate market volatility, regulatory risks in redevelopment, and the sobering fact that the core business continues to lack sustainable growth. Investors must understand the psychological truth about Bombay dying. This is not a compounding machine that rewards patience. It is a special situation story, an asset monetization play where returns depend not on yearly performance, but on the timing and scale of land sales and project redevelopments. The upside is binary. When assets are unlocked, short-term gains can be explosive. When they are not, the business offers little beyond its legacy brand name. In essence, Bombay dying is not a journey of continuous growth, it is a bet on events, a stock driven by moments of extraordinary windfalls and long stretches of operational stagnation. It demands clarity of thought from those who engage with it, for it is not the dream of compounding wealth, but the gamble of unlocking hidden value at the right time. If you found value in this deep dive, I invite you to like, share, and follow. For those who seek clarity in complexity, subscribe to stay connected, because every story in business has lessons worth learning, and every number tells a truth waiting to be uncovered. I am Zayed Haji, your host, signing off here. Until the next episode, stay healthy, stay informative, take care.